Hey guys, it's Sebastian from AskSebby. Today we're going to look at how to invest in companies before they IPO. We'll look at a bunch of different tactics and also the pros and cons of each. Big favor before we dive into all of this is to give that like button a little pop. And hopefully that joke makes sense with why we're considering this. So why would I want to do this? What's the point of all of this? I would say that there's two main arguments. The first one is that you can use this as a mechanism to buy good long-term companies at a cheaper cost basis. If you're long-term bullish on either the company or the space, then it makes sense to plant that seed earlier rather than later. I'm pretty sure you can think of a lot of companies that fit that profile. The short-term argument is that IPOs have historically popped on their first day of trading. Tanyu G. wrote a very good Medium article on this, looking at 2020 data. I'll link that down below for anyone interested. So of the 61 IPOs that debuted on the US stock exchange in 2020, the median company saw a 20% pop on the first day of trading. So what does this tell us? The pop basically says that investment bankers underpriced it relative to what the market is willing to pay. This ends up shortchanging the company out of money. For 2020, the median was 44 million, and on average, it was 110 million. If you're someone focused on the short term, then this can be a pretty interesting play. With that said though, how do we get into these deals? Number one is to be an insider or a super user of the company. One of the best and most recent examples of this was Airbnb. They sent out an email to their superhosts allowing them to buy up to 275 shares at the IPO price of $68. Most people were allocated 200 shares, and there's even been people who were not superhosts who also got allocation. Daniel Chan is a very good example of this. He's a magician. He has been on the Airbnb platform for experiences. So 200 shares at $68, and the lowest that we've seen Airbnb since is 139. Even if you're not bullish on the company in the long term, you can still flip that for a quick exit. And there were people who did exactly this. They ended up doing this and made $15,000 in profit. The pro is that it's going to be generally a good price and they're rewarding the super users. The con is lack of access for most normal people. So this is going to be the investment banks, hedge funds, and just big money. So why is this? During the IPO process, investment banks go to these capital institutions like pension funds, endowment funds, and hedge funds and form these syndicates. If you're someone who's very high net worth and you work with a specific brokerage who's running that deal, then you might also get access to this, but you do need to be pretty high up there. For example, this person who manages $500 million couldn't get into a bunch of deals. The pro, I guess, is that it might help with your retirement funds. The cons are that retail ends up missing out on that potential upside. This is changing though because of fintechs who want to break down the walls. This is also why I'm generally a fan of fintechs, because they provide access to the non-billionaires and the non-100 millionaire crowd. On that note, this portion of today's video is sponsored by SoFi. Investing in an IPO involves substantial risk, including the risk of loss. Please review the important disclosures in the description below for more information. Offered by SoFi Securities LLC. SoFi is introducing IPO investing, allowing members who have at least $3,000 to invest in IPOs before they're sold on stock exchanges. So what does this mean? It means that you can get in on the action at the IPO price. This is a new feature for SoFi, which already has an all-in-one investing platform, allowing you to buy stocks, ETFs, and also crypto. They also have automated investing in fractional shares, which is awesome for retail investors because you can buy your favorite companies for as little as $1. If you want to check out SoFi IPO Invest, a big favor is to use the link down below in the description box, and you can get up to $1,000 when you open an active Invest account. The big pro for this is that they're giving the little guy a fighting chance for that upside rather than just letting the man line his pockets. The big disadvantage is going to be if these companies can get enough shares to satisfy the growing appetite. Thank you SoFi for sponsoring today's video. I still think that this is generally a good move though, and that leads into number 4, which is SPACs. SPACs are special purpose acquisition companies that are basically publicly traded shell companies that are set up to raise money, IPO, and then acquire or merge with another company. Put another way, it's a giant mountain of cash looking for a buying opportunity. The reason SPACs exist is speed to market and also assurance of a long-term investor base. SPACs are a double-edged sword though. In theory, a SPAC should not drop below its NAV. So if it's $1 billion, it should be at least worth $1 billion. At the same time, it can increase in value based off rumors of who it's SPACing with. Especially with the current pullback that's happening in the tech space, this might be a good opportunity for these companies to buy other ones at a discount. The pro is that these are easily accessible to everyday consumers. The con is that you're betting on the SPAC's management team to be able to find good deals and to close them. Number 5 is going to be marketplaces for late-stage private companies. There's a bunch of these out there, and the idea is that there's early employees or people who've invested in the company who want to liquidate some of their shares. Maybe you have a friend that works at Chime, but they're looking to buy a house. Knock on wood, there might be someone in your family who has a medical issue who doesn't have insurance, so you need to cash it out in order to cover that. Looking at one of the platforms, you can see Robinhood, Chime, SpaceX, and also ByteDance, which is really TikTok. We've also seen Reddit, Stripe, Instacart, and Casper do similar things. The benefit is that you can get into these companies earlier than the other options, and if you haven't noticed, we're pretty much going down the list based off timing. So you're getting in at a cheaper price, but this leads into a bunch of disadvantages. Number one is going to be the lack of liquidity. So Reddit is on these platforms, and you don't know when they're going to go public or whether they'll go public at all. You might be able to find another buyer during another opportunity, but that's still less easy than opening up an app and clicking the sell button. Secondary marketplaces still end up being pretty manual. The second major disadvantage is that a lot of these are targeted towards accredited investors, and the minimums can be pretty aggressive. For some of these platforms, they're looking at something like $20,000, and for other ones, it might be $100,000 minimum or $250 minimums to get into that specific deal. Even if you're having a great year, deploying $250K into one deal is pretty aggressive. Number 6 is even more aggressive, going one step earlier. It's investing in these companies at the early stage or mid stage. So for a lot of these platforms, they also have SpaceX and Robinhood, but they got in when they were a lot smaller. So for example, here their allocation for SpaceX was just $2.3 million and Robinhood was 11.2. It is a balancing act though. The earlier you get in, the lower the minimums and the better the price, but you also have higher risk. If you are someone looking to do earlier deals, then I'd make a lot of small bets rather than taking large positions. On a side note, on the other channel, Creator Capitalist, I did a video walking through a deal that's on this platform. If you're someone who wants to check that out, I'll link that down below along with the SoFi link. Again, thank you SoFi for sponsoring today's video. My question for you guys is, how do you think about this? And are you someone looking to invest in pre-IPO companies? Of these options, which one would you pick? Which one are you considering? Let me know and everyone else know in the comments down below. If you liked it, give it a thumbs up. If you know anyone else who benefit, share this with them. Will probably help them out. But otherwise, hope you guys liked it. See you guys next time.